Well, it's the weekend and you're watching a brand new episode of Smart Money. Now, in today's episode, Radhika Gupta, MD and CEO of Edelweiss AMC, joins me. She needs no introduction, but we're going to talk about something which is very close to my heart. All the mistakes that we have made during our, journey in the last perhaps decade. For her, of course, 2-decade-long investing journey, and more importantly, the lessons that you've learned through it all. We will also talk about some long-lasting ways for young investors like you to build wealth for yourselves so that you can, sort of achieve all of your financial goals. Radhika, welcome to the show. Always great having you here.
Thank you. Great to be here on a Friday.
Absolutely. And there are so many lessons that we've learned, right? But if I had to go back and be 20 again, I wish somebody had guided me at that time, and I'm sure you would say the same. So what has your overarching lesson been in the last 20 years?
So my number one lesson, I think, has been the importance of sort of listening to your own voice and doing what is right for you. And I think it is so relevant in the social media world where someone is giving you a tip to do this and someone is saying do that. But really, I believe investing is very personal. And I remember I had started investing in 2006 and 7, and I put everything into equities because people said, oh, you're young, just do equities. And Sonia, my husband and I are both in the financial services industry. The crisis of 2008 hit. And for us in a market crisis, incomes fall, bonuses fall, stock options fall, and equity markets fall. And we realized because our profession is so high risk, we actually need to be a lot more conservative. And since then, I've made sure that I pay attention to asset allocation, and more importantly, I do what works for me. And that's one lesson I would tell everyone: don't listen to your neighbor, do what works for you.
Okay, listen to your inner voice. I think that applies to most things in life, right? Not just investing. So let's start with some common mistakes that all of us make, right? One of them is failing to start early when investing. I think I've done the same because I was always very risk averse. My salary, I would, hold it close to myself, put it in FDs, be a little scared about equities. Were you the same?
I was, and I wasted 2-3 years despite being an investment professional. And the problem with not starting early is a couple. Once you start late, you always have this feeling of FOMO that I've started late. And you want to take more risk to kind of make up for the fact that you started late. Secondly, all of us make investing mistakes. And I always say it's kind of better to make those mistakes on a smaller corpus than when you start at 35 and you're earning a lot more money. And I think the solution to starting early is you don't need a lot of money to start. If you're investing in funds, you can start with 500 rupees a month. That's what we spend on Netflix or on coffee or anything. And just make a habit of starting. Target a post-tax amount of your salary that you want to put into investments. Do it via an SIP every month. At least you've got the habit going.
Okay, so start early, right? That's one of the big things, and that's perhaps a mistake that both of us have made. Let's also look at why exactly starting your investment journey early helps. So if you, suppose you're someone who's young, you're 20, 25 years old. Somebody the other day told me that a 20-year-old, 25-year-old doesn't even have money to spare. What do you do then?
I think everyone has money to spare. So if you're earning 20,000 rupees a month, it's not a huge amount of money. A lot of 20, 25-year-olds do earn that amount of money. Target that you're going to save 1,000 rupees a month. Your post-tax income is probably 15,000, 17,000 rupees. Just say I'm going to save 5% of it. Do an SIP with it so that that monthly habit goes out. The reason I think this works is we all pay taxes, right? So you don't say I don't have money to pay tax because you have to pay tax, right? An SIP is an automatic deduction. So it's like an investment tax. I call it the investment tax for young people. Get into the habit. Once you do 1,000 rupee one, you'll see your portfolio accumulate. Believe me, the next year you'll go and say, maybe I should take this to 2,000.
Okay, so start with how much ever money you have. It can be as low as 500 rupees, 1,000 rupees, it doesn't matter. Got that. Let's move on to the third question now. A lot of investors that we see, bank on asset allocation, right?
Yes.
What's your take on that?
It's super important. Most people don't know what it means and how to break it down. I call it a balanced diet equivalent. You don't want to only eat protein. You want to eat protein and carb and fat, etc. And while most of us talk about equity, and equity is a great asset class for wealth creation, the reality is when our portfolios are down 30-40%, we get scared. We get nervous. We want to run away from the market. And these things are natural. You need other asset classes like debt to be a cushion in your portfolio. The other thing is sometimes you just need to take out money. And if I made this mistake in 2009, Sonia, when I had to come back to India to start a business because 100% of my money was in equity. I redeemed when equity markets were down 50%. I didn't have a debt allocation. if I did, I could take out money. So debt is always your place to take out money if you have a need. And again, today there are so many ways to do asset allocation without wrangling your brain over it.
Okay, so asset allocation is important. Got that. Moving on to the fourth one, right? Another big lesson that you've learned along the way is stepping up your investments in SIPs. We all know that, you got to do SIPs and all of that. But at what point do you decide to step up your investments? Is it when you get your increment? Is it when you get your bonus? And do you continue to invest in the same fund or do you diversify?
So I like to look at my portfolio and SIPs every 2-3 years. And I learned this mistake when I was doing one of these reviews, and I realized this is my post-tax income, this is the amount of SIP, and my bank account is suddenly getting a lot bigger, and I have a lot of surplus cash because I didn't top up the SIPs. Most of our incomes hopefully grow. So the nicest and most automated way to do it is to do something called a top-up SIP, which a lot of funds allow, where you can automatically have it increase, or you do a manual review. To the second question about funds, I like to have less funds. I get very scared when I see portfolios with 80, 90. I've seen portfolios with 300 funds these days.
Are you serious?
Actually, I think most investors need about 10 funds. So just doing more of the same works. It really simplifies your life.
So 10 funds, 3 in large cap, maybe 3 in mid cap, and 3 like flexi cap funds. Is that the way to look at it?
2-3 multi-cap funds, 1 or 2 mid and small cap funds, maybe an international fund, maybe a hybrid fund, or maybe an arbitrage fund. You are done.
Okay.
10 is high, actually, 8 to 10.
Okay, 8 to 10 funds in your portfolio. Another mistake to avoid, according to you, is the FOMO factor, right? The fear of missing out. Now, I want to talk a little bit about this. In 2008, when most of us started our careers, at that time there was this Lehman crisis. I doubt any of us would have invested in the market at that time because there was, forget the fear of missing out, there was just plain fear.
Yeah, there was fear of world ending.
Yeah. So how do you sort of, go against the tide?
I think documenting what you need really helps. So I write down a set of investment principles for myself. These are the kind of returns I want. This is the kind of, like, if my portfolio loses 10%, I'm comfortable. But if it loses 30%, personally, I'm not comfortable. These are the kind of funds I want to invest in. These are the things I will not do. And that document, it's a one-page document. It's almost an anchor for me. And now me and my husband, we manage things together. It's an anchor for us not to fight with each other also, because we know what we want. So I think having a set of basic principles sometimes avoids FOMO. And FOMO is a lot more prevalent these days because we live in a social media driven world. So it's very easy to get a tip or someone to say, oh, I made 30% returns in small cap, you only made 15%. And you start thinking, oh, maybe I should have done 100% small cap. And the reality is it's not right for you. So writing things down sometimes is really helpful.
Okay, it's interesting you say that you and your husband had a fight about, money. Somebody asked me the other day, what are the 3 or 4 questions that I need to ask the person I'm in a relationship with, money-related questions, to make sure that this is going somewhere? What would your answer to that be?
By the way, I get girls who set up calls with me, and this is one of the kind of questions they ask. What is the kind of person I should marry? So this is not such a surprising one. I think you need to have a common set of values about money. How do you believe in saving? How do you believe in spending? Is money going to be managed separately or jointly? Are liabilities and loans going to be in both of your names?
Do you believe in having a joint bank account?
I believe in each person having their own account. You can have a joint bank account for convenience. Now, it's a very personal thing. But as women, I do believe we should be in control of our money because life is truly uncertain and money is hard earned.
Absolutely. Okay, let's move on to the other mistake. We're talking about 12 investment lessons and we're on the 6th one. Rushed investment, right? Rushed investment decisions. Would that be only restricted to equities, or do you think that also comes in the light of, say, maybe when you're buying an apartment, real estate, or even gold? What are the mistakes that you made along the way?
So I think rushed investment decisions are really important because the more thinking you do before investing, the less pain you'll have after investing. I have also done these mistakes. Sometimes I think the source of these mistakes is someone shows you this really attractive. I remember going to see a prospective apartment and the builder told me, if you don't do this in 2 days, the price will be up by 30%. And, thankfully I didn't fall for it, but I know a lot of people who do. And what I want to say is that no investment opportunity is running away. And even if it is running away, no investment opportunity is worth investing in if you don't understand it. It's just not worth it. And reality is, I don't think most things run away. So this mistake happens in property, this mistake happens in equity, this mistake can happen in an unlisted investment, can happen anywhere.
So did you go ahead and buy that property?
Thankfully not. I don't like illiquid investments too much, so I'm very careful about that.
Absolutely. Even I believe in that. After the age of 40 particularly, I think 80-90% of your investments should be liquid, right? Because if you have a property, however good that property is, it will take you a minimum of 1 year to sell it properly, right? To get the right price in the market. When you go to buy a property, it's very easy to buy. But when you actually go to sell it, is when you realize the pain.
And you have taxes, you have maintenance in the middle that you don't factor into account. You have all this extra transaction costs. So we worry sometimes about 20 basis points of expense ratio in funds. But if you start looking at the expense ratio of properties on a recurring basis and on an exit basis, it's very, very high. So someone really has to give me a serious premium to invest in something illiquid. And I always say that, you want me to do something illiquid? Tell me why you're giving me much more than what I could in a liquid option.
Okay, there are a lot of pearls of wisdom here, but I do need to take a short commercial break. Don't go anywhere. We'll be back with Radhika Gupta of Edelweiss AMC to talk about her mistakes along her investment journey and the big learnings along the way as well. Stay tuned.